Andy said, my name is Richard Lishman. I'm the principal of Money4Dentists. We're one of the leading specialist independent financial advisory firms to dentists in the UK. My colleague here is Sarah Smith. She's one of our associates. Do you want to grab a chair, Sarah? I'll get this one. Yes, it's done it for everything. Make you feel welcome. And we're going to talk about a number of different financial aspects of financial planning. Some of it is mainstream, but we're actually going to talk about some more interesting aspects as well. Now, we've been around since the 1990s, so we're nice and established. We exclusively advise dentists and their partners, and have done since day one. So if a lawyer wants to be a client of ours, nothing wrong with lawyers, we work very closely with them, but we would decline them as a client. We exclusively work within the dental sector. Now, if your partner is not a dentist, which is often the case, then obviously we're not going to turn them away as a client because it's a unit. Okay, but all of our lead clients are dentists. And what that means is 100% of our resources are focused on your profession. So you can speak freely about jargon, UDAs, PCTs, etc. We know everything about business side of dentistry. Okay. We have a clinical director as well, so we get any up-to-dates with regards to any major clinical changes within dentistry, which is important. From a personal point of view, I write for pretty much all of the dental journals, PPD, BDJ, the Probe, and so on and so forth. So it's not just about taking from you guys, provides us with a great lifestyle, thank you very much. It's all about giving back and educating our audience as to the potential strengths and weaknesses going on in business side of dentistry. Okay. We have won many awards as well over the years. In the last 2 years we've won 5 financial awards, and these are independent awards, a bit like the Dentistry Awards, which we're sponsoring this year. The financial awards are run by organisations like Financial Times, so top-end organisations. It's not a few people getting a backhander and then there's winning those awards. So we've got, hopefully you'll agree that we've got a credence, and hopefully now I'll be able to provide you with some information which you'll find beneficial. So, a quick agenda on what we've got planned. We're going to look at income protection and the right type of protection that you should be considering. I'll touch on retirement planning as well, and then I'll hand over to Sarah, who'll run through practice and residential mortgages, and finishing off with some tax planning. And if anybody does have any questions at any point, just feel free to ask away. We will be around for the rest of the day as well, so if you want to ask any specific questions that is obviously particular to your own individual needs and requirements, then come along and we can have a one-to-one. That's more convenient for you. So, I've already discussed choosing the right advisor, but there's a number of different types of financial advisor. There's either a tied financial advisor, a multi-tied, or independent advisors. A tied financial advisor works for one financial institution. So Ray mentioned Lloyds TSB. Their financial advisors are Scottish widows. They can only advise on Scottish widows products. Okay, so it's very restricted. It's a bit like, would you use 3M for everything? Got it. Then you have multi-tied. So an example of a multi-tied advisor is somebody like Wesleyan or Medical Sickness Society, and they have a limited number of areas that they can give advice on. And again, they're acting on behalf of the company that they're working for. And then the third type of advisor is the independent financial advisors. And an independent advisor is very different because they're obliged by law to act on behalf of their client. So the client could go to an independent financial advisor, explain what they need, and the advisor is obliged by law to provide the best solutions for that individual. Okay. Then there's obviously general advisors that perhaps are dealing with a bricklayer in the morning and an accountant in the afternoon, so they don't really have any speciality, they're just general. And then the specialists, and obviously, as I mentioned at the start, we are specialists, we are independent, so we feel that we're qualified to be here to be speaking in front of you today. I mentioned the awards as well, so moving on to income protection. Now there's a number of different types of income protection contracts, and many of you in the room will already have income protection in place, but it's making sure you've got the right income protection contracts in place, because there's good and bad. And there's actually one company, I won't mention the name, but the marketing initiative looks like the lady's recently lost her husband and she looks Scottish. But basically they've never ever paid out on an income protection claim. Okay? And they're a huge provider. So making sure you've got the right income protection is so important, because you can have suited, own, or any occupation status definition. The example that I just gave you is at any occupation. So if you can still weave baskets, they won't pay. And as clinicians, you need your hands. So it's paramount that you have an occupation definition. Suited occupation, if you can go to lecturing, then again, the policy would not pay out. So that's why an occupation definition is the key. So if you lose a finger, you can't carry extractions, then you know that your lifestyle is going to be maintained for the rest of your career, or would have been your career. And then you've got the choice if you want to go into research or lecturing another profession at a later date, then you can. Okay, any questions on that? Then you also need to make sure that you review the cover that you have in place, because if you've got a dentist where their income is, say, £100,000, for argument's sake, and they may insure that income, if, let's say, they cut the days, and you only work, say, 6 sessions a week, and their income falls down to, say, £50,000 a year, but if they're still insured for the 100, based on the 100,000 income, in the event of a claim, they will only receive benefits based on the 50,000. We see a lot of new clients coming on board where they perhaps haven't reviewed any of their contracts, never mind their income protection, for some time, and they're overinsured. And we're here to protect clients to make sure they're not paying for something they don't need. Because what's the point? You know, we work hard for our money, protect it, make sure you're managing it in the right way. So have regular reviews with your professional advisors. Any questions on that? Brilliant. Moving on to life and critical illness cover. Again, following the theme, making sure you've got the right contracts in place. Now, if you're single, then really you probably don't need life insurance, because if you're dead, you're dead. Well, even if you've got a mortgage, there's an argument for not even insuring, because you're still dead, but you know, what's the point of having an asset there for either the government to benefit from, or perhaps, yeah, it'd be nice if your parents received a lump sum, but do they really need it? So it's really important, again, that you position yourself correctly with regards to the protection you've got in place if you need it. We would tend to consider things like if you do have any financial dependence. Now that could be an elderly relative that you want to take care of, it could be children, or it could be a large debt, be it personal or practice finance debt. So again, make sure that you've got the right protection plans in place. Now there's 2 different types of contracts you can have. Reviewable, which for the first 5 years the premium remains the same usually, but then year on year thereafter, depending on how many claims, how many people died during that period, the insurance company has the right to increase the premium by an unlimited amount. So if someone's paying £30 a month for a bit of life insurance over that 5-year period, let's say there's been a couple of harsh winters, obviously the mortality rates are changing, people are dying, then that's going to increase the price of that cover. If that increases to £100 a month, that's a huge hike. Now you may think, well actually I'll just go to another provider because life insurance doesn't have any investment element to it. If you've had any medical problems, or if your health has deteriorated during that 5-year period, you're scuppered. You've got to stick with that provider because you may get a load-in, or a rating as it's sometimes called. So if the premium should be £30, because you're a higher risk, the premium may be £150 because the likelihood that you'll die is greater. Okay. So if you go for guaranteed premiums, you'll pay a slightly higher premium initially, but long term you'll save a fortune. So we would always encourage, for the right clients, if you can, always budget for guaranteed premiums, because you know where you are. People like peace of mind. And then critical illness cover. This is where you die a bit. Okay, so you've still got your mouth to feed, you've still got all the stuff going on around you. You may still have your mortgage, you may have your practice finance, but you've had a heart attack, or you've been diagnosed with cancer, dread diseases. And this cover was actually designed by a chap in South Africa called Maurice Barnard, whose brother Christian did the first heart transplant. And he could see that there was people on a life support machine with huge amounts of life insurance, but the family wasn't getting any money, and they found it really difficult from a financial point of view. So he decided to design a contract that paid out when this particular individual had died a bit. Now when people have heart attacks, they live a normal, healthy lifestyle afterwards. 20 years ago it's very different, and with medical advances, things are improving all the time, and critical illness definitions are actually changing all the time. Prostate cancer was a big one in the past. A lot of policies did include that. Now very few of them do, because people are diagnosed, the likelihood is they'll die of old age anyway. Okay. So any questions on that section? Now, the NHS pension scheme, I'll just touch on pensions briefly. Do we have many members of the NHS pension scheme here? Yeah, a good few. Do we have many private dentists? Right, and a mix as well, I assume, yeah. Okay, brilliant. Now, what's people's perception of pensions? Good? Bad? Right, so mixed. Okay, brilliant. Right answer. Now, pensions can be very good if they're managed correct. Now, a pension is just a tax shield that the HMRC allow everybody now in the UK to have a pension scheme, even newborns. You can have a pension. The government don't want the responsibility, basically, so they're trying to encourage everybody to have pension schemes. Even if you don't have an income, you can still get tax relief on your premiums going in. So it's very tax efficient. But anyway, most people in the room either will be a member of the NHS pension scheme or will have been a member at some point of the NHS. Now recently we've been faced with a number of new clients coming to us where they've been recommended to opt out of the NHS pension scheme. Now I think this is absolutely crackers. It's one of the strongest pension schemes in the United Kingdom. It's guaranteed, it's backed by the government. So why would anybody think about leaving the NHS pension scheme? And I'll tell you why. Recently, dentists could incorporate. A few years ago, you guys had the gates opened, and it seemed to be a good idea to incorporate because of certain tax breaks and tax advantages if you do incorporate. I won't go into that now because of the time, but if anybody wants to know more about it, then grab us at the lunch, etc. And what happened was a lot of associates thought, actually this is great, because I can save tax, which everybody likes to save tax, as Ray mentioned. Now the problem is, if you've got an associate that incorporates, And if they're working in the NHS, they forego 100% of their NHS benefits. That means that they will not get any NHS benefits if they're an associate. Principals is fine. If you're a principal, then you're okay, or a partner. But it's actually specifically for associates that are doing NHS work. If you have incorporate, or if you're thinking about incorporate, don't do it if you've got NHS work, because you won't benefit from any NHS pension scheme or any of the benefits, such as 2-time death and service benefit, widow's pension, etc. Okay. So any questions on that?
Which age man can claim NHS pension?
It depends on the age that you are now, and it depends on when you're looking at retirement. Generally, it's from around age 55, but there are early penalties. It depends if you're in the old scheme or if you're in the new scheme as well. The new scheme, the normal retirement age is 65, the old scheme was age 60, but you can actually retire early. There's all sorts of ill health possibilities as well, but there's also penalties for retiring early. So as an example, if you're in the new scheme, which your retirement age is 65, and you wanted to retire at age 60, then you'll miss out on the 5-year service, so you're going to end up getting less, but also you'll get a 25% reduction on your overall pension as well, which is a penalty because the NHS is going to have to pay you for an extra 5 years. Okay. Any other questions? Okay.
The private pension, you want to talk about it?
Yeah, I'll touch on, we're okay for time for a couple of minutes. Private pensions, so we've discussed the NHS, private pensions. For every £1,000 invested into a private pension scheme, it only costs high rate taxpayers. I mean, the highest rate of tax now is 50%, it increased from 40%, and the actual effect of the tax works out that you're actually paying 60-ish% in tax because you lose your personal allowances as well. For anybody earning in excess of £150,000. If you're earning circa 100, then you're paying just 50% in tax. Anything over that, and anything below, you're obviously going to be on the 40% mark. So if you invest into a personal pension, it's a great way of getting some money back from the government. So if you invest £1,000 into a personal pension scheme, your own private scheme, then initially it will only cost you £800, and then at the end of the tax year you'll get a further £200 back as well. So the net cost to you is £600 for a £1,000 investment, which is fantastic. I think it's brilliant. Now you need to make sure that you're not paying over the odds in charges, because there's some historical personal and private pension schemes that aren't the cheapest. So just be aware of the type of pensions that you can invest into. Charges are very important, because if you've got, let's say, 4% in charges, and the return is 6%, that's a net return, or net yield, as we call it, of 2%. Whereas, if you actually only have charges of 1.5%, the headline rate and return doesn't have to be that high to break even, as opposed to the first example.
Private pension was very not reliable last 3-4 years, especially when this recession started. Some private pension they call it state funded.
Say that again.
State funded. State government
right. Yeah.
or state funded. What is that?
The problem is with private pensions, it's there isn't a good or bad pension. In the press, you read all the time that pensions are rubbish. They can't be rubbish. They're just a contract. It's a bit like saying an ISA is rubbish, or an actual product. It's just an incentive that the inner revenue have put forward. It's the underlying investment funds that could be rubbish. And that's what you need to manage, because quite often when we're taking new clients on, they may have a portfolio of X hundred or X million pounds invested into equities, and that could be through stocks and shares ISAs, it could be in things like maximum investment plans, other tax efficient savings and pensions. Now, it may be that in their 20s, when they set these schemes up and these plans, that they were quite an aggressive investor. You know, they were thinking, oh, 20, 30, 40 years before I need to get my hands on that money. Let's take huge risks and hopefully we'll make huge returns. Now, what can happen is people never review their investment risk. And if you think about it, if you were retiring in 6 months, would you want an aggressive approach to your portfolio? Of course you would. You'd want to hold on to it. You want it to be very cautious. So the bad press comes down to the individuals not reviewing their investments. Because if, let's say, 5, 7 years before you need the money, you know, when you're in your early 50s, if you actually slide some of that across into more cautious funds, so cash, fixed interest, gilts, etc., not all of it, but perhaps, you know, 10% a year over a number of years, then you've still got exposure to some equity, but you've got the safety net of the money that you've built up over your years. And if you do that, then the product itself, the pension, will just carry on doing its own job. Does that answer the question okay? Any other questions before I hand over to Sarah?
If you mix NHS and private, so I like work in the hospital and I work in private practice, so I have an NHS pension scheme, you know, should you be doing a private scheme as well, or should you be just topping up your NHS one? What's sort of the best solutions for them people to do mix, really?
Possibly both. The NHS is great, but it's not good enough in its own, on its own. It's not. It's you'd have to be 20 to go into the NHS, and I don't know of any dentist that started work within the NHS at 20, usually it's 23, 24, and you'd have to work to age 60. And I don't know many dentists that actually want to work till 60. In fact, I don't know many dentists at the moment that want to work tomorrow. We keep seeing the line. But anyway, nevertheless, let's assume that you'll get through that. So even in that example, if you were planning on retiring at age 55, you've missed out on 9 years service, and you're going to have the 25% penalty for retiring early. So rather than retiring on a maximum of half of your income, so let's say your income is 100k from the NHS, rather than you retiring on the maximum, which would be 50,000, which is taxable, you'd probably end up in that example having an income of around 25, 27,000, which is going to also be taxable. So it may be worthwhile considering topping up the NHS pension scheme, which under the new scheme, the maximum you can top the NHS pension scheme up is by an additional £5,000 income, okay, retirement, by complementing with your own private scheme as well. It doesn't have to be all or nothing, it can be a bit of both. Yeah? Any other questions? Fantastic. Right, well, thank you very much. I'll hand over now to Sarah Smith.
Very much, Richard. So we're going to move on now to mortgages and residential finance. Just in the room, have we got people that have already bought? Have we got any people that haven't yet bought? Okay. Well, if we start with the basics then of how you go about repaying your mortgage, well, there are going to be two main types here. You've got interest only, or capital and interest, also known as repayment. Interest only is where you just pay the interest back to the lender. So say you took out a mortgage of 200,000, in 25 years you're still going to owe them 200,000. You need to sort out some sort of investment or some sort of plan of how you are going to pay back that lump sum. With capital and interest, what you pay back is a mixture each month of the interest and the capital. So assuming you make all your payments on time, in 25 years' time that mortgage will be paid off and that house will be yours. So once you've established how you're going to pay it back, you then need to look at what type of rate you want. So there are going to be three main types of rate you look at. Now you've got your fixed rates, your variable rates, and your tracker rates. Fixed rates, as they say on the tin, your rate is fixed for the next 2, 3, 5. It is possible to get 25-year fixed rates. These are great for those who like to budget. The disadvantage is, if you buy when the markets are high, you may end up paying over the odds because your rate's going to be fixed at a higher rate than you could potentially get in 2 or 3 years' time. Variable rates, now these are rates that are set at the lender's discretion and can vary with their discretion. Now they usually follow the Bank of England base rate, but they don't have to. So again, they're great if you think the rates are going to fall, but they can change on you unexpectedly. Tracker rates, now these rates do follow the Bank of England base rate and have to. Base rate is set in the first week of the month, so potentially you have got 12 changes in a year. However, base rate has been 0.5% for over 2 years now, so potentially you have basically had a fixed rate, but it can and will at some point go back up. So what rates are on offer today? Well, in terms of your fixed rates, they're starting at about 2.88% at the moment. And in terms of your trackers, we're looking at about 1.59. So they are low, but not as low as base rate. And if any of you are looking at buying or indeed remortgaging, please come and see us because we'll be more than happy to help you with that. In terms of the loan to values available, we are looking at a maximum residential at 90% loan to value, so you do need to find a 10% deposit, but there are still ways and means of getting around that, so if you haven't got it, still do come and speak to us because we can help. If you're looking at sort of buy-to-lets and investment properties, you're looking at a loan of 80 to 85%, so you'll need to make up the difference yourself. And if you do want to look at overseas mortgages and buying in other countries, again, depending on the country, you're looking at needing between a 50% deposit or anything up to then 15%, depending on where you're looking. And again, those mortgages, they can be in sterling or the local currencies. So again, do speak to us because we can help on those. One of our unique benefits working purely in the dental market is that we can get the full status mortgages for those associates that have been self-employed for sort of weeks and months rather than years. We don't need to wait for you to get the 3 years accounts. Because we work purely for you guys, we've built up relationships with lenders where we can show how you're going to get paid, and we understand and they understand how you get paid. So we don't necessarily need you to have those years accounts. Sometimes you'll find you'll go to the estate agents and they'll just say, you haven't been self-employed for 12 months, there's nothing we can do. There is. If you come to someone who's a specialist in your area, we can help. We also put you in charge of how you receive your updates in terms of your mortgages going through. So we basically provide the service that you need for your mortgage, so we can be as proactive in the contacting you as you want. You can receive updates from us in terms of text messages, emails. We also don't stick to the traditional 9 to 5 hours for when you are buying a house, so we can help a great deal there. In terms of offset mortgages, does anybody here have offset? I mean, if you're self-employed, the benefits there are huge. Essentially, you're not going to pay interest on your savings, but you're also not going to pay interest on your loan, in the difference between what you have in your savings and what you have in your loan. I mean, to give you a bit of an example, if you've got a mortgage of 300,000 and 50,000 sat in savings, if you're paying 3.44 on your mortgage and you put that 50k in your savings account, you're effectively only going to be paying 2.87% on your mortgage. And you can either choose to reduce your monthly payments then, or just pay back your mortgage early. And obviously if you're not earning any interest, you can't be taxed on it, which is great. And also with that, there are lenders that will let you offset up to 12 different accounts, so you don't have to be worried about putting all the savings in one pot. You can still have your 12 different accounts, so you can have your taxable money, your holiday fund, your current account. It can all be separate with instant access, but it's helping you pay it all back early. Has anybody got any questions on mortgages? Anything?
We're talking 1.9. How much
1.9.
deposit you are looking for?
You do need a 40% deposit. If you are looking at the lower rates, a 40% deposit. If you're looking at sort of 10%, you are near the 5-6% mark, but it can still be done. The bigger the deposit at the moment, the better the rate that is on offer. Any other questions on any of that? I was going to move on to practice finance now. However, we've all heard from Ray this morning, who is the man when it comes to things like that. So I'm going to skip over that slide, if that's okay. So, moving on to tax planning and tax efficient savings. Basically, there are 3 types of tax you are going to pay in your lifetime, but all of these can be reduced with careful planning. So looking at income tax payable on your income, either under PAYE or via self-assessment. Capital gains tax on your capital growth. Unfortunately, there is very little you can make a profit on in this country and not pay tax on. And inheritance tax. payable on your estate when you die, and this as well can be greatly reduced with careful estate planning. So if we start with ways to reduce your tax, well, this could be your traditional tax-efficient savings such as ISAs, premium bonds, tax-exempt savings plans, but they're not the only tax-efficient savings. There are other products that allow you to put an unlimited amount in. So it is important that when you're speaking to advisors, you don't just look at your ISAs. But ISAs are a great way of saving for the future. The ISA limit for everybody now is 10,680. You could put your 5340 into cash, or the full 10,680 into stocks and shares, or you can save regularly on a monthly basis. It is important to shop around for your cash ISAs. You'll always see that they have a great headline rate in April. What you'll often find is that will disappear the following April and it will drop down to 1% or something like that. So it is important that you do regularly review even your cash investments like that. If you are looking at transferring things like your cash ISAs as well, please make sure your bank do it for you. If you try and do it yourself by moving the money around, you will lose its tax efficient status. So just please make sure when you go in, you do transfer it in their way, not by just moving the money yourself. Cash ISAs are great for your emergency funds and for your cash savings, but any sort of long-term growth is going to be eroded by inflation, unfortunately. So for that, you really do need to be looking at stocks and shares ISAs for sort of the longer term. With stocks and shares, it is important that you do seek some sort of advice because there are thousands of funds out of there, and we're not going to expect you guys to understand what that fund's going to do for you or where it sits or how it's going to work. So what we can do there is analyse each of those funds for you and make sure it fits in with your attitude to risk and how much risk you are prepared to take with your investments, because it is vital, again, that you keep regularly reviewing those funds and making sure they fit with your lifestyle. Another way to reduce your tax bills, we've spoken about it before, is just to use things like specialist accountants. Again, somebody who is aware of all the tax rates available to dentists, because that can help as well. Moving on, how many people here have got a valid will? A few, excellent. I mean, the benefits of those are huge. They're going to help mitigate your inheritance tax. They're going to make life so much simpler for your family at a difficult time. They ensure that you give the money to who you want to and it gets distributed as you would have wanted. It also clears up any confusion for unmarried homeowners, which is an important one, and it does appoint a legal guardian for your children, which again is vital. And if you don't have a will, ultimately your money could end up going to the Crown, and is that really what anybody would want? It's also important that you need to keep it up to date because marriage and divorce will invalidate it. So just do make sure you do keep it up to date. I mean, our aim here is to make you financially independent at an age of your choice through things like your pension planning and your tax efficient savings, but making sure it is reviewed because that is key. Final one, income tax is voluntary. We have access to many interesting initiatives. One will limit the amount of stamp duty you pay when buying your next home. Another will in fact eliminate your income tax liability for both the previous and current tax year. In essence, you won't need to make a payment on account in July or for the next two. It is really important to tell you now that it follows government legislation, it's not loopholes, and it has been validated in the High Court. Now, there are certain criteria you need to fit, but many of you in the room will. So you do all have feedback sheets on your seat today. Please complete them. We are, both myself and Richard, will be around for the rest of the day. So do please come and have a chat. Has anybody got any questions? Thank you very much for your time.
Well, thank you very much, Sarah. Thank you, Richard. We're due for a break now, so refreshments you'll find outside to enjoy. And can we be back in here promptly in 20 minutes' time? So 20 minutes' time back in just after 1:45. That'd be good. Thanks very much.
Yeah, certainly.